Okay, dear students, let's just start the third live revision class SBR session March 25. Provision and events after the reporting date. Basically, provision, contingent liabilities, and contingent asset. That is IAS 37, and this is IAS 10. IAS 37, provision, contingent liabilities, and contingent assets. In IAS 37, the number one thing is you should be having a really good understanding of provision, because when provision recognition criteria is met, only after that you can recognize the provision. Otherwise, we cannot recognize the provision. Repeat. Under IAS 37, provision will only be recognized when provision recognition criteria is met. Now the question is, what is the provision recognition criteria? Before coming to this, a provision is a liability of uncertain timing or amount. Now come here. The main concept, when will you recognize the provision? When the recognition criteria is met. So when do we recognize the provision? Recognize when an entity has a present obligation. Now this present obligation could be legal or constructive as a result of past event. An entity has a present obligation. So you need to know one thing. When there is a present obligation, it means you cannot pull out yourself unless you satisfy that liability, because it's a present obligation. So I cannot pull out myself without settling the liability, without discharging my liability, without paying off for my liability. So recognize when an entity has a present obligation, which could be legal or constructive. Legal, we know that by contract, by law. But when we say constructive obligation, basically constructive means which arises due to past practices of the company, or constructive means which could arise due to public statement of, let's say, BOD, which could arise due to policies of the companies. For example, let's say an organization is having a policy of paying dividend. Every year they pay the dividend. At the end of each year, company pays the dividend, or company pays the bonus. Let's say company is having a policy of paying the bonus to their employees, but there is no written agreement with the employees, but they have a history of paying bonus at the end of each year. It means that even though there is no obligation, there is no written contract, even it is not mentioned in an employment contract as well that we will give you the bonus, but company is having a history of paying bonus at the end of each year. So that's a constructive obligation. So according to IAS 37, provision will be recognized when an entity has a present obligation, which could be legal or constructive. Constructive means which arises from your past practices, could be from your public statement, could be because of your policies as a result of past event. The second point is, it is probable that an outflow of economic benefit will be required. So it is probable that an outflow of economic benefit will be required. Probable means more than 50%. So there are more than 50% chances that outflow of economic benefit will be there. Third, a reliable estimate can be made. So when all the three conditions are met, only then you will recognize the provision. Now listen carefully. For example, if an organization wants to recognize the provision for the future operating losses, according to IAS 37, you cannot recognize the provision for the future operating losses. Why? Because a very first point of recognition criteria says an entity has a present obligation which actually arises from a past event. So when you are saying that I'm going to run the business in the future and I'll be having operating losses, so that is a future event. So you cannot recognize the provision due to any future event. So you cannot recognize the provision for future operating losses. In fact, if your company believes that when you are going to run the business in the future, you will be having future operating losses, then it is an indicator of impairment loss. Then you should be thinking for the impairment rather than IAS 37, you should think for IAS 36. Similarly, an organization cannot recognize the provision for the future capital expenditure. You cannot do that. You cannot recognize the provision for the future capital expenditure. In fact, organization cannot make a provision for providing employees the training in the future. Because the first point says an entity has a present obligation, legal or constructive, as a result of past event. Past event. The second is there are more than 50% chances there will be outflow of economic benefit. And the last point is a reliable estimate can be made. Measurement. An amount recognized should be the best estimate of expenditure required to settle the obligation. Basically, when you are dealing with a large population, then you should be making the provision on the basis of expected values. So in case of large population, provision will be according to expected values. For example, if your company has given, let's say your company has given the warranty for 1 year, you have sold the goods, and let's say the warranty says if there are minor defects, company is going to bear the repair expenditure. If there are going to be any major problem, company will replace those items. And let's say history says 10% of items sold, they return for the warranty claim. And out of that 10%, let's say 40% they go for minor repairs, 60% they need replacement. So it means you are dealing with a large population. So you should be making provision on the basis of expected values. But when you are dealing with a single population, then your provision should be according to the best estimate. Single population means, for example, let's say one of your customer has filed a suit against your company, and your lawyer says that we will lose the case. Okay, if you will lose the case, then you are asking your lawyer how much we have to pay. The lawyer says there are 90% chances that we have to pay $1 million. There are 10% chances we'll be paying, let's say, $0.5 million. So when you are dealing with a single population, then your provision should be according to the best estimate. So here the best estimate is, let's say there are 90% chances I'll be paying 1 million. Go for 1 million because you're dealing with a single population. But when you are dealing with a large population, then we make the provision on the basis of expected values. Where the time value of money is material, the provision should be discounted to the present value. So where the time value of money is material, normally if I say that, let's say I have to bear we have to bear the cost after 12 months, for example, then you should be calculating the provision on the basis of present values. Even in exam, if the time period, there's a gap of 6 months, still you should be calculating the provision on the basis of present values. Where the time value money is material, but IAS 37 has not exactly mentioned that how many months time value of money is material. It is not mentioned in IAS 37. So I'm just giving you the professional judgment. Of course, if something is claimed after 12 months, so you have to make the provision at its present value. But even the claims are coming after 6 months, you should be thinking for the present value of provision. So where the time value money is material, the provision should be discounted to the present value. So our provision is a liability of uncertain timing or amount. Now, provision. Specific guidance. Future operating losses provision should not be recognized for future losses. In fact, as I mentioned earlier, if your company believes that your company will be having future operating losses, then you should consider that as an indicator of impairment loss rather than thinking for the provision. So according to IAS 37, you cannot make provision for the future operating losses. It does not fulfill the criteria of provision recognition. Onerous contract provision should be recognized for the obligation under the contract. Onerous contract means where cost of fulfilling the contract is more than benefits. Onerous contracts where cost of fulfilling the contract is more than the benefits. Then according to IAS 37, in case of onerous contract, obviously you have to recognize the provision. But under onerous contract, provision should be recognized lower of actually honest contract means where cost of fulfilling the contract is more than the benefits. That's an honest contract. Okay. Now I need to recognize the provision. Then according to IAS 37, provision should be lower of two amounts. One is the net cost of fulfilling the contract. Net cost of fulfilling the contract. And the second is the penalty amount. For example, let's say your company has taken a premises on rent for 5 years. For example, your company has taken a premises on rent for 5 years. There's an agreement between company and the landlord that before the 5 years, you cannot return the property. And if you return the property before the 5 years, there's going to be a breach of contract and you have to pay the penalty of, let's say, $1 million. Now, assuming in the first 2 years, everything was going fine, but the year number 3, business is having problems and the premises which they have taken on rent, it is no more needed. Now, organization has two options. Number one, to bear the penalty and return the premises. And the second is to still keep the property for the next 3 years and just pay annual rent. So in that case, organization should calculate what is the net cost of fulfilling the contract and what is the penalty amount. Whichever is lower, you have to make the provision for that. Because there's a possibility when you are taking that when you are still holding that premises and running the business in that premises, so you will have to bear the, let's say, loss of $50,000 every year, assuming. But the penalty amount is 1 million. So it's better to bear the loss rather than paying 1 million penalty. So you have to check in case of onerous contract that one, you have to recognize the provision. The second is the provision will be lower of net cost of fulfilling the contract and penalty amount, whichever is lower. Sir, if there's not any significant variation in the net cost and penalty, for example, it is $1 million, it is $1.1 million. So what will you choose? Will you go for 1.1 million or 1 million? This is my question. Students, please reply. Or will you go for 1.1 or 1 million? Please. Only financial factors. So simply just keep yourself at financial factors rather than non-financial factors. I'll go for 1 million. Okay. So honest contract means it's a contract where cost of fulfilling the contract is more than the benefit. In that case, I'll be recognizing a provision lower of What is the net cost of fulfilling the contract and the penalty amount, whichever is lower. Okay. Third, restructuring. Provision can only be recognized where an entity has constructive obligation to carry out the restructuring. A constructive obligation arises when there is a detailed formal plan and plan has been announced to those affected. Actually, number one thing you need to understand when under IAS 37, when do we need to make the provision for the restructuring? Logically, there are two types of restructuring. One is positive restructuring, another is negative restructuring. The main concept is we do recognize the provision, of course, after meeting all the conditions, but provision will always be recognized for a negative restructuring, not for a positive restructuring. What do you mean by this? For example, your company is running the 5 different businesses. Now your company is thinking to launch the new business. So obviously there will be then 6 businesses. That is also a restructuring. That earlier we were having 5 businesses, now there will be 6. But that's a positive restructuring. There's no provision for that. But if you have 5 different businesses and you are thinking to, let's say, close one of them, or you are thinking to close and sell one of them, so that's a negative restructuring. So provision will always be recognized for a negative restructuring, not for a positive restructuring. Another point is, normally when we think for the restructuring, we think for the negative restructuring. It means things are not good in the business. Now, according to IAS 37, provision for restructuring will only be recognized when there's a constructive obligation to carry out restructuring. A constructive obligation arises when there's a detailed formal plan and which has been announced to those affected. Means detailed formal plan approved by the BOD and there's a proper public announcement to those they are affected. For example, to the key stakeholders. Normally, 3 stakeholders, they are very key. Number one is those employees. They will be affected by the restructuring. Obviously, you have to inform them. Second, customers, they will be affected by the restructuring, and the supplier. So these are the 3 key stakeholders. You have to inform them. So you will be recognizing a provision for the restructuring when there's a detailed formal plan and there's a public announcement to those they will be affected. A restructuring provision should only include the direct cost of restructuring. So restructuring provision will only include the cost which will be the result of restructuring. For example, due to restructuring, let's say company will have to bear the redundancy cost. So that will be a part of restructuring provision. There's another possibility due to restructuring, there will be a breach of contract and let's say we have to bear the penalties. Again, that will be a part of restructuring provision. So only direct cost of restructuring will be taken in the restructuring provision. Another point is, according to IAS 37, once let's say organization has made a detailed formal plan and there has been an announcement to those they will be affected by the restructuring, then IAS 37 says make sure there should not be a significant delay in implementing the restructuring plan, because if there is a significant delay in implementing the restructuring plan, then again, according to IAS 37, you should not be making a provision for the restructuring. Even though, let's say, you can say that, so there's a detailed formal plan which is approved by BOD, and let's say there's a public announcement as well. But the question is, when will you implement the restructuring plan? That is very important. If you say that I'll be I'll be implementing this restructuring plan, let's say after 2 years, after 3 years, it's a really big delay in implementation. So according to IAS 37, there's a significant delay. And when there's a significant delay, obviously it is most likely that there will be no restructuring. So a very important concept is there should not be a significant delay in implementing the restructuring plan. If there's a significant delay in implementing the restructuring plan, then you should not be making a provision for the restructure. Another point is, again, very important. You will only be recognizing a provision for the restructuring when there's a detailed formal plan and plus announcement. To those, they will be affected. As I mentioned, employees, obviously, those employees, they will be affected. You have to inform them. Customer and suppliers. And just let me tell you one thing. It is not necessary that always you have to inform all the employees they will be affected by restructuring. What do you mean by this? Just think for a labor union, okay? And instead of announcing each and every one, we have just announced the restructuring plan. We have informed about this restructuring plan to the leader of labor union. So obviously, if you have informed to the representative of the labor, that is considered as a proper announcement. So when there's a detailed formal plan, and let's say you have made a public announcement as well to those that will be affected, employees, customer, and suppliers, only then you will be making a provision for the restructuring. Another point is only that cost will be included in the provision of restructuring, which will be the result of restructuring. Another point is there should not be a significant delay in implementing the restructuring plan. And the last point is we prepare provision for negative restructuring, not for the positive restructuring. Okay. Contingent liability. Contingent liabilities should not be recognized. They will be only disclosed. They should be disclosed unless the possibility of the transfer of economic benefit is remote. If it is remote, then no need to disclose as well. Remote means, for example, the chances of outflow, they are just 5 to 10%. Take it as remote. Contingent assets should not be recognized. If the possibility of an inflow economic benefit is probable, they should be disclosed. If there are more than 50% chances you will be getting benefit from the contingent asset, then you can disclose. Again, you cannot recognize. So a contingent liability is a possible obligation, whose existence will be confirmed by uncertain future event outside the entity's control. For example, assuming there's a case going on a company and the lawyer says, let's say the lawyer says there are 30% chances you will lose the case. Obviously, then it is a contingent liability. A contingent asset is a possible asset whose existence will be confirmed by uncertain future events, again outside the entity's control. Now let's quickly see IAS 10, events after the reporting period. Basically, events after the reporting period, there are two types of events. One is adjusting event, another is non-adjusting events. According to IAS 10, if there's an adjusting event, you have to obviously adjust your financial statements. In case of non-adjusting event, if it is material, then you have to disclose. Events after the reporting periods, events which occur after the year end but before the financial statements are approved, authorized, means now the financial statements are ready to go to the stock exchange. For example, let's say the financial year is 1/1/24 till December. Normally, what happens? Normally, it takes 3 months to finalize the audit, and the books will be authorized to go to the stock exchange. Let's say March 25. So according to IAS 10, those events which will occur after the reporting date but before the authorization of financial statements, and normally it takes 3 months to authorize the books. So it means those events, they will occur after December 24 and let's say till March 25. So That is the scope of IAS 10. Events after the reporting date, but before the authorization of financial statements. Now, any event which will occur in these two dates, if that event pertains to the previous year financial statements, then we have to think either it's an adjusting event or non-adjusting. For example, on December 24, company had the information that one of their customer is going to be bankrupt. December 24, they got the information that one of their customers is going to be bankrupt. Let's say after their end, assuming on 31st January 25, that particular customer goes bankrupt. So you have to recognize, you have to basically adjust your financial statement. Why you have to adjust your financial statement is because on SOFP date, you had the information that one of your customer is going to be bankrupt. Now, actually, you know that on 31st January 25, that customer is bankrupt. So it means that now I have to adjust my financial statement. Let's say there was a receivable of $10 million and now you'll be just getting 1 million. So you have to recognize the loss of $9 million. So events after the reporting period, events which occur after the year end but before the financial statements are approved, gives new evidence on condition which existed at the year end. Then it's a adjust financial statement. Like I have given you the example that one of my customer is going to be bankrupt on SOFB date. We had this information, but the confirmation comes after the year end, but before the authorization of financial statement. So this is an adjusting event. So event gives a new evidence on condition which existed at the year end, adjust financial statement. Gives new evidence on condition which did not exist at the year end. Then simply give any other disclosure, like what is the nature, estimate of financial effects. But you will only be disclosing that non-adjusting event when it is material. Another thing is, gives new evidence on condition which did not exist at the year end, but impacts going concern assumption. If it impacts going concern assumption, again, it becomes adjusting event. For example, on SOFP date, on reporting date, obviously company did not have any information regarding, let's say, theft of a stock, fire of a stock. So fire of a stock, theft of a stock, these are the examples of non-adjusting events. So if after the reporting date, before the authorization of financial statement, there is any theft of a stock or let's say fire of a stock, so it is treated as non-adjusting event. If it is material, you have to just disclose. But now, if there is a fire of a stock and the loss of that due to fire, the loss is so significant that going concern assumption of the company is not valid. Now this becomes an adjusting event. Now I have to adjust my financial statements. In fact, if the going concern assumption is not valid, then entire financial statement will be made on the basis of breakup values. Breakup values means net realizable values. So you need to check one thing. If an event is a non-adjusting event, immaterial, you have to disclose, but the event itself was a non-adjusting event, but the impact is so significant that the going concern assumption is not valid, then it becomes adjusting event. So these are the questions in which examiner has tested IAS 37 and IAS 10. And I believe almost all the questions you will find in our practice videos if you are watching. Now let me share the another slide, another IFRS in fact. Okay, students, IFRS 5 non-current asset held for sale. I think you should be having you should be asking the planner from the admin. If you do not have the planner, you should contact admin. Admin will give you the planner where it will be mentioned date wise how many lectures you should see by certain dates. So you should contact admin. Definitely they will give you the planner. And the good thing is, planner will start from your joining date. So you should ask admin, definitely they will help you. Okay, great. IFRS 5, the first part of IFRS 5 we are discussing right now, that is non-current asset held for sale. We know that the entire IFRS 5 says non-current asset held for sale and discontinued operation. IFRS 5, an asset should be classified as held for sale if carrying amount will be recovered principally through a sale transaction. Means you will not be using it and getting the economic benefit. You will be getting the economic benefit by selling the asset. Then you will be thinking for IFRS 5. Read it again. An asset. An asset should be classified as held for sale if its carrying amount will be recovered principally through a sale transaction. To be classified as held for sale, the following criteria must be met. Most of the time under IFRS, if there's a question on IFRS 5, I would say 80 to 90% chances are that examiner will be testing the criteria that should we apply IFRS 5 on that asset or not. To be classified as held for sale, the following criteria must be met. The asset must be available for sale in present condition. Means if you want to sell a property, plant and equipment, let's say, and assuming you have given the advertisement, buyer is there and they really want to buy the plant which you want to sell. But if your company says that we cannot sell the machine right now, we cannot sell the property, plant and equipment right now, because right now this property, plant and equipment is busy to fulfill the contract of a customer, and we will sell you after 6 months, after 8 months. So if you are saying such thing, then IFRS 5 is not applicable on this property, plant and equipment because your asset is not saleable in its present condition. But if your company says there's another way of selling the machine is that we will sell you the entire machine right now with the contract. Means now instead of we completing the customer's contract, you will be fulfilling the contract of the customer, and let's say whatever the necessary legal issues are there, let's say you can fulfill that. If it is possible, then IFRS 5 is applicable because now you are selling the asset. But the main concept is if you're selling the asset and you're saying that you have to the buyer, you have to wait for 6 months, 8 months before I do this, that, then it means your asset is not saleable in a present condition. When your asset is not saleable in its present condition, then IFRS 5 will not apply. Another point is sale must be highly probable, means after applying IFRS 5, asset should be sold within 12 months. Management must be committed to the sale. Actually, your management should carry out the actions and those actions should show the commitment of the management that yes, your company really wants to sell the asset. The asset should be actively marketed at a reasonable price. Reasonable price means what is the current market value right now? If you know that your property, plant and equipment, even though you bought it for $10 million, but right now the market value is only $4 million, you cannot ask 10. Now, if you're asking 10, it means you don't want to sell the asset. You're not asking a reasonable price. So reasonable price means now normally what is the market value of your asset? The asset must be expected to sell within a year. If the criteria are met, the asset should be measured at the lower of carrying amount and fair value less cost to sell. Very important. If the criteria is met, the asset should be measured at lower of carrying amount and fair value less cost to sell. If the asset is measured using a revaluation model, then it should be revalued to fair value before being classified as held for sale. Actually, before applying IFRS 5, you need to calculate updated carrying amount of the asset. Updated carrying amount of the asset. Updated carrying amount of the asset means if that asset needs depreciation before applying IFRS 5, you have to depreciate. If you are following IAS 16 revaluation model, and that, let's say, then you first, before applying IFRS 5, you should check for the revaluation surplus. After that, you'll be applying IFRS 5. So very important concept is before applying IFRS 5, you have to calculate updated carrying amount of your property, plant and equipment. Updated means if it needs depreciation, I have to depreciate. If there's a revaluation surplus, I have to recognize the revaluation surplus as well under IAS 16 revaluation model. Then this updated carrying amount will be compared with fair value minus cost to sell. Then obviously whichever is lower, that is updated carrying amount and fair value minus cost to sell. For example, I'm just assuming, okay. Let's say there's a plant. Assuming the carrying amount is $100 million and remaining, let's say useful life is 10 years. Assuming on 30th June 24, IFRS 5 criteria is met on 30th June 24. And fair value of asset is, let's say, 110 million. Fair value minus cost to sell is 107 million. Now, what IFRS 5 says, before applying IFRS 5, you have to calculate updated carrying amount of the asset. So let's say the plant carrying amount on 1st January 24 is 100 million. First, I have to depreciate for the 6 months. That is 5. So 30th June 24, the carrying amount is 95. Now, assuming company follows IAS 16 revaluation model. Repeat, okay? Assuming company follows IFRS, company is following IAS 16 revaluation model. If company follows IAS 16 revaluation model, so I have to compare this 95 with 110. So I need to recognize the revaluation surplus. Now what will be the double entry for this 15? Plant is debited by 15. Revaluation which goes to OCF 15. Now, updated carrying amount of plant updated carrying amount becomes 110. So on 30th June 24, the updated carrying amount is 110. Now, when the criteria is met under IFRS 5, asset is measured at lower of updated carrying amount and fair value minus cost to sell. Updated carrying amount is 110, but fair value minus cost to sell is 107. Now, under IFRS 5, asset is recognized lower of updated carrying amount and fair value minus cost to sell, which is 107. Now, from 110, I have to bring my asset to 103. Now, this is important. You have to recognize the impairment loss. And that will be directly recognized in P&L. And your plant, which is held for sale, is 3. Now, listen carefully. Even though we have just recognized the revaluation surplus of 15 million, but the main concept is under IFRS 5, whenever we need to recognize impairment loss, that impairment loss directly is charged to P&L. Under IFRS 5, we never adjust the impairment loss against the revaluation surplus. Under IFRS 5, we always recognize the impairment loss to the P&L. So under IFRS 5, if there's a reversal of impairment loss, that will go to P&L. If there is an impairment loss, we have to recognize in P&L. So simply under IFRS 5, we never create revaluation surplus. We never reduce or eliminate revaluation surplus. But if instead of IFRS 5, if I talk about IAS 36, according to IAS 36, when you need to recognize the impairment loss, then first you need to see, is there any revaluation surplus in the carrying amount of the asset? If there's a revaluation surplus, then IAS 36 says 36. First, eliminate the revaluation surplus. If the loss is more than the revaluation surplus, then any loss which is over and above the revaluation surplus amount, that will be charged to P&L. But the main concept is under IFRS 5, impairment is always charged to profit and loss. Another point is under IFRS 5, maximum reversal of impairment loss. Maximum reversal of impairment loss is equal to impairment under IAS 36 plus impairment under IFRS 5. So again, extremely important concept. Maximum reversal of impairment loss under IFRS 5. Maximum reversal of impairment loss under IFRS 5, that is equal to impairment under IAS 36 plus the impairment under IFRS 5. Now come here. If the asset is measured using a revaluation model, then it should be revalued to fair value before being classified as held for sale. The asset will be presented as a current asset. So basically, under a current asset in SOFP, you have to show your plant held for sale. No further depreciation is charged. After applying IFRS 5, not before. After applying IFRS 5, no more depreciation. After applying IFRS 5, no more depreciation. So once the criteria is met, the asset should be measured at lower of this carrying amount is actually updated carrying amount and fair value minus cost of sale. If the asset is measured using a revaluation model, then it should be revalued to fair value before being classified as held for sale. And the last one says the asset must be presented as current asset. And then there are a number of questions in which examiner has tested this IFRS 5. Okay. In today's class, I had a plan of discussing IAS 12 with you, but deliberately I'm not doing it because there are still students, they have not seen that IAS 12 yet. But if you people are attending all the live revision classes, I think you should have noticed this live revision class is a bit longer than the previous two classes. As I mentioned earlier as well, that slowly and gradually the live revision classes duration will increase. And now in the coming Saturday, inshallah, the live revision class is going to be really far more longer than these three classes, inshallah. And I'll be discussing a number of IASs, plus we'll be discussing the kit questions as well. And what I'm going to do today, Saturday, so maximum by Monday or Tuesday, I will share the questions as well in the WhatsApp group, that which questions we are going to discuss and which IASs or IFRSs. But please, live revision classes, they will be continued, inshallah. But try to complete the lectures, pre-record lectures as soon as possible so that you can get more time for the practice. So just last minute of the class, student, is there anything, if any one of you want to ask, so you can ask before I end the today's class? Any question, anything, student, if you want to ask, please go ahead. Anything? Nothing, students? So thank you very much. Please do give the feedback of today's class in your respective WhatsApp groups. And see you all inshallah in the next class as well. Thank you.